Alright, hi guys, this is Adam Khoo here with the latest market update. It's the 2nd of April 2019 and we've just closed the first quarter of 2019 up pretty strongly. So the US markets are up, S&P 500 is up 13% so far for the first quarter. The Dow Jones is up 11%. China's doing really well, right? China, Shanghai is up 27% first 3 months and the Hong Kong Hang Seng's up 14%. My portfolio is up about 30% as of last night, which, I mean, it's okay. It's pretty decent. There we are, right? So the last month over here, for the last 1 month, my portfolio's up 5.79%. And for the year to date, it's up, 30.46% year to date. Right, so 30% up for the first 3 months, not that bad. Again, it doesn't go up, every single month. There are up months, there are down months. By the end of the year, if I can get 50 to 60% return on my investments, I'm pretty happy. And that's what I normally do each year. That's how I compound my account. So been pretty bullish. So what's been happening with the S&P 500? We started the year right at the bottom after the bear market. The baby bear market last year that started in October. We had a huge bear market. We had that parabolic plunge when most people would panic and sell. And at that time, if you had listened to the media was saying that, hey, a recession is coming, the bear market is here. And when people read this media, what do? They sell. And remember that if you want to beat the market, you must go against the crowd. Be greedy when others are fearful and be fearful when others are greedy. So when people are panicking and they're selling, causing this 90-degree drop, that's when you should be buying the moment you see a reversal pattern. So we saw this strong reversal pattern. This is called a one white soldier pattern. That's when I started entering the market. The moment I saw that bear market, I was buying put options on my portfolio. So as it collapsed, I made some money. I closed my put options and then I went long again all the way up. And then we had that resistance that I was talking about for the last couple of videos, right? So we hit that resistance and it looked like we were coming down over here. So I actually bought some put options to protect my portfolio again. But what happened was it reversed back up, broke above. So I had to close my put options with a slight loss on the put options, which is fine because buying put options is like buying insurance on your portfolio or buying insurance on your house, fire insurance. You're paying a premium. So if the house doesn't burn down, don't get upset, you paid the premium, right? Let it expire. So lost a couple of $1,000 on the put options. That's fine because the moment it broke out like that, I started to buy more call options as well on the SPY. All right, so right now we're at 2867. You can see we've broken out of this resistance over here. We've broken out. And then we came back to retest the 20 EMA. And right now we're here. So our next target for the S&P is 2940. That's the next target here. So we've got pretty good upside over there. All right, so that should generate more gains for the portfolio in the next month or so, right? So doing really well. The US market, really bullish right now. If we can break above that previous high, we got to be careful. Sometimes it could break above and it could be a false breakout. So we got to see where it goes. It can break out strongly, then the sky's the limit for the rest of the year. But we've got to see how that goes. Now for China's been amazing, right? So the Shanghai index, Shanghai Composite Index, let's take a look where it is. Right, you can see for the first 3 months, boom, it's up 27%. Okay, but having said that, remember that it's coming off a huge decline. Okay, last year China had a 24% drop, its worst drop in 8 years, and people are panicking, there's blood on the streets, and that's when I said we gotta buy. Right, again, to profit, to beat the market, we gotta be greedy when others are fearful. So at that time, China was dirt cheap. The PE ratio was 9 to 10 PE ratio. I said that's the time to buy. I was buying great China companies like Baidu, Alibaba, Tencent, Ping An Insurance. I was buying the China ETFs. And sure enough, we had that strong rally. Remember, what goes down must come up. for index ETFs. We're up 27% for the year, but we're still cheap, right? Despite the China market being up 27%, Shanghai, Hang Seng is up 14%, it is still relatively cheap because the PE ratio of Shanghai is about 15 and Hong Kong's about 11.6. So it's still undervalued. I see a lot more upside for China stocks and China ETFs. So as for me, I use China ETFs like the GXC. So this is the China ETF, which tracks the China market mostly through Hong Kong shares, right? So you can see this was a very clear downtrend. This was a false breakout, okay, and then it did a double bottom over there, and boom, it broke out of this trend line, and it started to go up over here, right? So I was accumulating ETFs all the way, and again, it's really far from the previous high, so a lot more upside to go. I'm still very bullish on China. I believe that in the years to come, or not years, in the months to come, in fact, we should be going back to the previous high over here of 123.9. So right now it's only at 99. There's still a massive upside for the China market, right? So again, I'm using the GXC to buy the China market, and GXC is listed on the US exchanges, right? There are other China ETFs, right? You have got CAF as well, and you can see the same pattern, right? After the double bottom, boom, very strong trend up. And the difference is the CAF tends to track the Shanghai stocks, whereas the GXC tracks the Hang Seng Hong Kong stocks, but they're more or less pretty correlated, right? So, and some of my stocks which I've been buying, I've mentioned in previous videos, is Tencent, which is the largest social media stock in China, right? So you can see very nice downtrend to uptrend reversal over there. Very nice, right? So I started buying over here and up pretty much, but we have got a lot more upside to go. You can see the high was $61, it's now at 44, so still a lot more upside for Tencent. Again, the largest social media company in China and the largest online gaming company in the world. And we have got also the other one I bought, Ping An Insurance, the largest insurance company in China. That's Ping An, right? And this one you can see has broken above the, oops, sorry. Right, there was a resistance over here. It was in a consolidation, broke above, so it's going to test the previous high at $25. So currently at $23, got a bit more upside to Ping An, but I believe that it will break above with a lot more upside as well. The other one would be Alibaba. All right, again, Alibaba, the largest e-commerce company from China. Again, you can see there was a downtrend, did a double bottom, and boom, it's up, but still below the previous high. So a lot more upside for China stocks. I'm still very bullish on China stocks. I'm still adding on to my China ETFs and stocks when I see minor pullbacks on the overall trend. Okay, now back to the US market. All right, so you can see the US market, we are bullish right now, and we are going back to test the previous high of 2940. Okay, but is the US market expensive? That's the question. Well, currently the PE ratio for the S&P 500 is 18.69. So what does that mean? Now, historically, the average PE ratio of the market is about 15. And at the top of the cycle is about 25 to 30. The bottom is about 5. So it tells us that at 18.69, the US market is not cheap. It is over the fair value of 15 PE, but it is not extremely expensive at the top at 25 to 30, which means the US market is expensive, but not extremely expensive. I still see quite a bit of room to run before we hit the 25 to 30 levels. So one of the things that is driving this market right now, despite slowing growth in the economy, is the Federal Reserve kind of like changing their policy decision, because they actually wanted to raise interest rates twice this year. But they announced that they're going to be kind of like, slowing down the rise of interest rates. And in the March FOMC meeting, they decided to hold the interest rate. So again, with lower interest rates, that increases the valuation of stocks, and hence that creates bullishness in the markets. Okay. Now the interesting thing is, you've been again reading or watching the media, which you should never do to make investment decisions. But if you've been reading the media, the big thing in March was about the inverted yield curve. Inverted yield curve is basically when the 3-month T-bill, the Treasury bond yield, basically goes above the 10-year Treasury bond yield. And that's when we have an inverted yield curve. And historically, that has predicted a recession 90% of the time. Okay, so a lot of the media has been playing that up. They say the yield curve is inverted, recession is coming, and that is what is causing people to panic, to sell their shares, or to not get into the market. So should you ever listen to the mainstream news? The answer is no. Okay, the way to lose money is to listen to what the mainstream news says. Remember, to make money, to beat the markets, you have to go against the crowd. You have to do opposite of what everyone is doing. A legendary trader, Jesse Livermore, said this: the market is designed to fool most of the people most of the time. All right. Now, I'm not disputing the fact that there could be a recession coming. Yeah, there could be a recession coming, but just because the yield curve inverts doesn't mean that you should not buy stocks. And a very simple reason is this: understand that the stock market is not the economy. Let me repeat that. The stock market and the economy are not the same thing, right? The stock market, in fact, moves 6 to 9 months ahead of the economy. The stock market is the leading indicator of the economy. So to make money, we follow the stock market, not the economy. And we follow the stock market by looking at the price action. Is it an uptrend or is it a downtrend? Higher highs, higher lows, or lower highs, lower lows. So as long as you follow the trend and look at valuation, you're going to make a lot of money. And don't ever listen to the opinions of these so-called experts in the mainstream news. So let's take a quick look at how the yield curve inversion has affected the stock market in previous years. So over here, we have got some statistics to look at, which is pretty interesting. And this goes back to 1958, right? So pretty long time, okay? So this was the date of previous yield curve inversions: 1966, 1973, 78, 1980, and so on and so forth, right? So you can see that this was the date the yield curve inverted, and this was the actual date the recession started in the US. So between the inversion date to the recession, what was the time in between? So it says here, inversion to start of recession, in terms of months, 48 months, 6 months, 15 months. So you can see it's all different. But if you take the average, it's about 17 months. So what does that mean? That means when the yield curve inverts, which it just did a few weeks ago, it means on average 17 months later, the recession will start. Okay? But again, it doesn't always happen. You can see that out of 1, 2, 3, 4, 5, 6, 7, 8 times, it was right 6 out of 8 times. Okay? But the most important thing is to know when the stock market hits the top before it starts reversing into a downtrend bear market. That's more important, because as investors, we want to get out at the top or to buy put options to protect our portfolio during the next bear market. Correct? Okay. So you can see over here, inversion of the yield curve to the start of the drawdown, which is the bear market. And you can see from the time the yield curve inverted to the start of the recession, from the time the yield curve inverted to the start of the bear market, it was 35 months, minus 5 months, 11 months, 2 months, 14 months, minus 3 months, 14 months. So again, it's different every time. But again, if you average it out, it's about 10 months, and it can be as long as 35 months. Okay. So what does that mean? That means that when the yield curve inverts, it takes 10 to 35 months for the stock market to hit the top and reverse into a downtrend. Now, during that 10 to 35 months, you can see that the stock market still goes up an average of 11 to 20%. All right, so what does that mean? You see, the yield curve has just inverted a couple of weeks ago. So that means historically, once it inverts, the stock market will still go up by 11 to 20% before it eventually collapses. If a recession does happen, which again happens 6 out of 8 times. In fact, let's look at the last time this happened, right? And it was January 2006. The yield curve inverted in January 2006 right at this point when the 3-month yield went went above, all right, sorry, it's a typo over here, right, went above the 10-year yield, okay? So when that happened, it took about 1, 2, 3, 4, 5, 6, 7, 8. Okay, let me just calculate. January 2006 to October 2007 is about 22 months, if I'm not wrong. It's about 22 months, right? So for the next 22 months, the market went up from here to here, which was over 20, I think it's about 24% or so. So there was a lot more money to be made in the markets in the next 22 months. And the market topped, and that's when the bear market started and the market collapsed 55%. And this bear market lasted for 1.5 years before bottoming in March 2009. And that is what triggered the new bull market that has lasted 10 years. I made a lot of money there, right? So again, as a trader, as an investor, we don't care when the yield curve inverts. Who gives a damn, right? What we care about is when the market tops and when this happens, all right? So we look at the price action from making higher highs. You can see on an uptrend, the market makes higher highs, right? Higher highs, and it makes higher lows. Okay, you can see this uptrend pattern over here. And how do you know when an uptrend has reversed into a downtrend? When you start to see lower highs and lower lows. Okay, now one lower low doesn't matter. 2 lower lows do not matter. When you see let me repeat that again. 1 lower high doesn't matter. 2 lower highs do not matter. But when you see 4 lower highs in a row, that is usually a confirmation of a downtrend. So what do I mean? Now if you can zoom in over here, take a look. That's a high. That's a lower high. That's a lower high, and that's a lower high. Can you see 1, 2, 3, and 4? When you have 4 lower highs in sequence, that's a clear confirmation the price action has reversed and we're in a bear market. And that's the time to sell everything, or to buy put options, or to buy inverse ETFs, or to short the ETF, so you can profit as the market collapses and make a lot of money during the bear market phase. And as many of you know, I also use moving averages to confirm the downtrend, right? So the moment the 50 moving average, the blue line, crosses below the 150 moving average, and both moving averages slope down, that's also a confirmation of the downtrend. So at that point, we had price action confirms downtrend, and that happened in January 2008, and that's when I basically sold everything. I used put options, and I made a lot of money as it collapsed. And once we saw the market bottom, reversing into an uptrend, again the 50 moving average crossing back above the 150 moving average, sloping up, making higher highs, higher lows, you get in and ride the 10-year bull market. So that's basically how I've been making money for the last, 25 years now of being in the markets. I just wash, rinse, and repeat, and I make money in any market condition. And if you can do, between 50 to 60% returns a year, you're a pretty happy camper. You can grow your wealth a lot faster than most people and, be financially free. All right. So basically, that's the quick market update. And Let me just also tell you a bit about Boeing. If you watch some of my earlier videos, the very tragic Boeing plane crash caused an investigation into Boeing, and Boeing's fleet was grounded. Some people canceled their orders for Boeing planes, and so Boeing stock had that big crash. Right? So Boeing from 446, it dropped to 363. Right? So we had that big crash over there. Okay? Now, if you watch my previous video, I said that Boeing's a great company, and this is a temporary problem that they're going to sort out. And this is a great opportunity to buy the stock at a discount. And in my last video, I calculated that the intrinsic value of Boeing was, well, actually, I can't remember what it was. Let me see if I can pull out that. Boeing. There we are. Okay, Boeing. That's right. Okay, so based on my intrinsic value calculator, the intrinsic value of Boeing is $493. That is the true value of Boeing. Now, I said that I like to get a 30% discount from the intrinsic value in case they lose orders from their Boeing MAX 8, right? Because that plane that crashed, it accounts for about 30 to 40% of the company's revenue. So assuming those orders get cancelled and they lose 30 to 40% of their revenue, the valuation drops by 30-40%. If you take a discount of 493, you should get 350. And so I said that I want to buy Boeing shares at $350. That would be a great discount to the shares. Okay, so but it never went to 350, right? It never went there. So in fact, it went down and it started to consolidate. It went sideways, and you can see there's a strong resistance that has become support over here. Okay, and despite all the bad news that came out, right? I think it was Air India that cancelled their plane orders and all that. Despite all the bad news investigations, it didn't go down, which tells me that I think the worst is over for Boeing. All the bad news has been priced in, and it was in a consolidation. It's a strong support, so I said heck. So I started buying. Right now, I didn't buy a full position. I bought a half a position in Boeing as it started breaking out over here. So now it's at 391. I bought in at an average price of let me see, what was my average price? I can't remember. Give me a sec. I bought it at, I just bought a small position on Boeing. Yeah. I bought it at an average price of 375. Yeah, that was my average price which I bought it at. Yeah, that was my average price which I purchased, 375, right? So I expect that, I think the worst is over. It's going to go back to 446 and higher and fly off again, right? But you never know, right? If there's another bad news that comes out, I hope not, but if there is and it crashes back down to 350 or 340, then I would buy again, right? I will average down my costs. Because as an investor, it's a great company. I've done my fundamental check. It will go up in the future, right? So any downside is an opportunity to accumulate at a discount, right? The other stock which I picked up, interestingly in March, was Domino's Pizza. And again, it's a great long-term investment. If you take a look at the long-term charts on the monthly candles, you can see that it's a very, very solid company on a very strong uptrend, and it tends to find support at the 20 moving average, right? So I've started accumulating here, quite good upside back to 305 and beyond. All right, so basically those are some of the changes in my portfolio. That's my read on the markets. Basically, the US, I'm bullish. I see near-term upside. We're expensive, but I think we're not extremely expensive. China's done really well, but to me, it's only the beginning of the Chinese bull run, right? China is still really cheap. I'm still accumulating whenever I see a temporary dip in Chinese stock. So this is Adam Khoo. I hope that you've benefited from this video. If you have, do subscribe for more videos or go to piranhaprofits.com to enroll in any of our courses. We've got the value momentum investing course. We've got an options course. We've got, by the way, yes, the options course is going to be launched on the 11th of April. So it's not officially launched yet. On the 11th of April, watch out for it. We're going to have a special launch promotional offer for you guys out there, right? So 11th of April, watch out for options, professional options course that's going to be launched. Meanwhile, you can enroll in our professional stock trading course, professional forex trading course, and value momentum investing course. So with that, guys, subscribe for more videos. I look forward to seeing you soon. May the markets be with you. Hi, so if you like the video, you can subscribe for more videos by clicking the subscribe button. If you want to find out more about our live training courses in Asia, go to wealthacademyglobal.com. For online professional stock and forex trading courses, you can go to piranhaprofits.com. So this is Adam Khoo, and I'll see you soon.